session, we're going to look at the capital budgeting process. And I guess first we'll need to define it. Capital budgeting process used to determine and select the most profitable long-term projects. So just like when we talk about capital markets as being securities that have maturities of greater than 1 year, when we talk about the capital budgeting process, we're talking about longer-term investments and how to decide whether to enter into a particular project or not. So our steps, first, probably the hardest step is the idea generation process, coming up with the ideas. Then we've got to analyze the project proposals, and that's what we'll spend a fair amount of time in this part of the classes for. And then create the capital budget for the firm, monitor the decisions, and conduct a post-audit. You want to monitor your decisions and see if your capital budgeting process, if the forecasts and estimates are biased. For example, if the cash flows are always bigger in the plan than they are in reality, then you need to adjust that. So that's an important part of this monitoring and post-audit function. Now, what types of capital projects? Well, just about anything the firm does where the returns come over a period of years could be considered a capital project. This could be a replacement project to maintain the business. That's a fairly low-risk project because the uncertainty about the cash flows are very low. We could have replacement projects for cost reduction. We've got a worn-out machine or a machine that's technologically outdated. Error rates, materials running too high, might want to replace that. Expansion projects, that could be expansion of a product line, that could be expansion of plant or distribution capabilities, or an expansion of the markets that you're trying to sell into. Introducing new products or entering brand new markets, well, that can be more risky. Mandatory projects like safety and environment projects, probably fairly low risk, just because there's certainty about the payoffs. If the EPA says they're going to fine you $50,000 a day unless you put in your smokestack scrubbers, well, you can be pretty sure what the cash flows from putting in those smokestack scrubbers might be. And then other projects, pet projects, or even research and development can be viewed in the context of capital projects and capital budgeting. So what are our overall principles? Well, we're going to be most concerned with after-tax cash flows. And we're going to need to use after-tax discount rates for consistency along with those. Because the tax implications for a corporation, I guess for any of us, what we care about is what we get to keep after tax, not what we earn before tax. And certain things like depreciation are going to affect our tax bill and affect our after-tax cash flows. Don't consider any sunk costs. If you've done a marketing study prior to making the decision, the cost of that study shouldn't go into your decision. Those are sunk costs. You're going to have to pay them whether you do the project or don't do the project. So what we want to isolate it down to in our capital budgeting decision making is how do the cash flows change if we do the project versus if we don't do the project. We've got to consider any cash opportunity costs. It may be the case that if we do a project, we're using some resources of the firm, say some of our floor space or a storage facility, that if we didn't do the project, we could lease it out and realize some cash flows that way. So those foregone cash flows from taking on the project, those cash opportunity costs, should be considered when you're calculating your after-tax cash flows. And you should consider externalities. Probably the most important is cannibalization. If a laundry detergent manufacturer manufactures brand new improved Blast detergent, we can probably suspect that the sales of old unimproved Blast detergent might suffer. So this is a negative externality. On the other hand, if you've been a maker of dryers and one day you wake up and have an epiphany and decide, gee, maybe we should make washers too, well, you'll have sales of the washers to consider, but since people sometimes like to buy sets, washer and dryers, you may increase your dryer sales as well. That would be a positive externality to consider when deciding whether to expand your product line to include washing machines. And as we'll see, the timing of the cash flow is very important because of the time value of money. Now, what about project interactions? Well, first we want to define independent projects versus mutually exclusive projects. Independent projects stand alone. Either do them or don't do them. Mutually exclusive projects, you can't do both. So maybe the project's to move the corporate headquarters and you're trying to decide whether to move it to Dallas or move your corporate headquarters to Chicago. Well, those both may be positive net present value projects, that is, profitable for the firm to do, but clearly you're not going to do both of them, and so you need to decide on one or the other. Project sequencing can be important because there's opportunities for profitable future projects. If a company managed to expand into Germany where they haven't been doing business and that goes successfully with one of their product lines, then they may be able to build on that distribution channel. They may be able to build on the brand name recognition that they've developed. So that's a future project. So the value of having an option to do that future project, if things go well with the first project, should also be considered in the capital budgeting decision. It's part of the plus side of doing the project. And unlimited funds versus capital rationing. Well, for large companies with good debt ratings, they can usually borrow whatever they need to fund profitable capital projects. But other companies don't have such access to the capital markets, and they'll have a limited amount of capital to invest. Well, in that case, they're going to have to ration their capital, and the idea there is to choose that bundle of projects which represent the greatest expected increase in the value of the firm. Now, one of our main tools, and the theoretically most preferred tool, is net present value. Now, you've seen this before in quantitative methods. And the net present value is simply the sum of the present values of a series of cash flows. In a simple project, this first cash flow is negative and all the rest of them are positive. Now, not all projects are like that, but that's a simple project. So in that case, we can think of the net present value as being the present value of all the future positive cash flows from buying a machine or building a factory minus the current costs of building that factory. So if in fact the present value of those future cash flows is greater than the cost right now, the net present value is positive, and we would expect this project, based on expected cash flows, to increase the value of the firm. Now, the calculation itself, fairly straightforward. We discount each of our cash flows. Here we have an initial outlay of 100, and then cash flows of plus 25, plus 50, and plus 75 over 3 years. Well, at some discount rate, that won't be a great idea. The net present value could be negative. Clearly, at a zero interest rate, it's positive because 25 and 75 and 50 add up to 150. So now let's look with a cost of capital of 9%. If we take the present values of all these cash flows and add them up, we get a positive value of $22.93. So according to this, we would say go ahead and do that project. It increases the expected value of the firm by $22.93. Well, here's some further points on that. Sorry. Net present value indicates the expected change in the value of the firm. I guess we covered that. We want to accept projects with net present value greater than zero because those are expected to increase shareholder wealth and the value of the firm. And accepting a zero net present value project won't increase shareholder wealth. The expected return just matches the cost of capital. When we use the phrase cost of capital here, that's what we're using to discount those future cash flows. We're discounting them at our cost, the firm's cost, of raising the capital, the financial capital, to purchase the assets. So our decision rule for independent projects is accept all projects that have a net present value greater than 0. A second measure that's very often used is the internal rate of return. The internal rate of return is simply this discount rate that if we discount all the cash flows at that rate, the net present value is 0. So just as with that first project we looked at, we said, well, at a low cost of capital, clearly that's a positive net present value project. At some higher rate, it could be a negative net present value project. Well, the dividing line is this internal rate of return, because that's the discount rate that makes the net present value equal to 0. At higher discount rates than that, net present value would be negative. At lower discount rates than that, the net present value would be positive. Well, when we take a look at the calculations here, remember that at 9%, we found that this project, same cash flows here, minus 100, plus 25, plus 50, and plus 75. And we found at 9% that had a positive net present value. So we know that the internal rate of return has to be higher than 9%. Well, you can solve for the internal rate of return using the cash flow keys on your calculator. You put in the cash flows, solve for internal rate of return. Well, when we do that, we get 19.4%. So how would we use this as a decision rule? Well, we would say if the internal rate of return is higher than the cost of capital, then we should do it. Then we should accept the project. It will increase expected shareholder wealth. But there's really no difference between that criterion and positive net present value, because the mathematics of it, if the internal rate of return is greater than our discount rate, our cost of capital, then the net present value is positive. So for independent projects, using the internal rate of return rule or using the net present value rule would result in the same decision. There's no difference at all. So here's our decision rule. IRR is greater than the cost of capital, and that's sometimes called the hurdle rate. It's called the hurdle rate because that's the rate that a project has to get over in order to be accepted. The payback period is not a measure of value creation. It's not an interest rate. It's primarily a measure of liquidity. The payback period just measures how many years until we get our initial investment back. Simple as that. And projects longer with a payback period that's longer than some arbitrary number, might be 3 years, are rejected. So the rule is if it takes longer than 3 years to get our money back out of this project, we don't want to do this project. Its limitations, first, it's not a measure of value. Net present value is preferred because it gives us a measure of the expected increase in the value of the firm from undertaking a project. And the payback period ignores the time value of money. We're using future dollars to balance against current expenditures. And it ignores cash flows beyond the payback period. If we had, going out years 1, 2, 3, and 4, 20,000, 40,000, and 15,000. What's that add up to? 75. So if we had 75,000 and we met our payback period, we couldn't differentiate between projects that have 100K out here in the 4th year or a project that had $1 million out here in the 4th year. It ignores these cash flows beyond our payback period. So if the payback period is 3, we ignore all the cash flows after that. They don't really affect what the payback period tells us. So the calculation's pretty straightforward. We just assume that the cash flows we project for a year are spread evenly over that year. So here we start out with an outlay of 100. We get 25 of that back the first year. So that leaves us 75 to go. We have 50 we get back the second year. That leaves 25 to go. our cash flows in the third year are expected to be 75. Well, 25 that we need to get back to 100 is 1/3 of that, so it takes us 2 1/3 years. So remember, the rule is, if it's less than some number, if our payback period cutoff was 3 years, we'd do this project. But remember, it's not a measure of value creation or interest rates. It really is a liquidity screen. We're saying we don't want to do any projects that don't get us our money back and turn us liquid again within this period of time. Now, the discounted payback period is just a little twist on this. I think at some point somebody said, you know, we had that list of things wrong with the payback period, and one of it was we ignored the time value of money. So, well, we can kind of fix that by using the present values of those future cash flows. Clearly, our payback period is going to be longer when we measure how long does it take to get back our initial investment in current dollars. So looking at that same project we had before, we're going to discount those cash flows back to their present values and just follow the same procedure. Our initial outlay is 100. The present value of our first year cash flows, assuming they come at the end of the first year and discounted back at 9%, 2294 leaves us 7706 we still need to pay back. Well, that second cash flow has a present value of 4208. That leaves us 3498 to go. The present value of that third year cash flow of $75 is 5791. So we just take the remaining present value we have to get back at the end of 2 years, 3498, over the present value of that third year cash flow. And instead of 2.33 years, now we get 2.6 years. But this still ignores any cash flows after the payback period and still just a measure of liquidity. The profitability index is the present value of the future cash flows divided by the initial cash outlay. But notice, since our net present value was the present value of the future cash flows minus the initial outlay, we can write this as 1 plus the net present value over the initial cash outlay. Well, as long as the net present value is positive, this is greater than 1, and we would accept the project. So our decision rule for this profitability index, accept all projects where the profitability index is greater than 1, exactly the same decision rule as NPV, and that's exactly the same decision rule as IRR. If we're talking about independent projects, any of these three rules would give us the same accept, reject decision. And that's an important thing to remember conceptually. Now let's look at a net present value profile. Certainly they can't require you to draw a net present value profile on a multiple choice test, but you could be called upon to interpret one. So what we've got here is we've got two different projects. And for each of these two projects, we have their cash flows, and then we calculate their net present values for different costs of capital. So this would be at 0 right here. At a 0 cost of capital, that would be the net present value. So if we did no discounting on any of the cash flows and just summed them up, this is what we would get. Now, both of these slope downward because as the cost of capital is higher, the net present value is lower. Well, right here, the net present value reaches 0 for project A, and right here, the net present value equals 0 for project B. Well, remember, we said the internal rate of return was that discount rate that makes the net present value 0. So, the internal rate of return for project A is 8%. We can read that right off the graph. And for project B, it's 15%. The next point I want to make from this graph is that we can see that we can't just take the project with the higher net or the higher internal rate of return. Project B always has the higher internal rate of return, but it doesn't have always the highest net present value. We look at a rate of 4% here, at a cost of capital or a discount rate of 4%. We call this the crossover rate because that's where the net present values of both of these projects are the same. But at rates less than 4%, Project A has the higher net present value. At rates greater than 4%, Project B has the higher net present value. So we always want to decide based on net present value. So we can't rank projects based on their internal rate of return. We can rank projects based on their net present value, but only when given the interest rate. Because as we can see here, the rankings can differ depending on what discount rate we use to calculate the net present value. So let's sum some of this up. For independent projects, internal rate of return, net present value, and what we can add one more to this too, right? We can add our profitability index, PI, all give the same accept reject decisions. Now for mutually exclusive projects where you have to choose one or the other or none, internal rate of return and net present value project rankings can differ, as we saw on that net present value profile diagram. Now why does that arise? Well, projects can have different timings of cash flows, or they could be of different sizes. In either case, these IRR rankings and NPV rankings can differ. And also, we're implicitly using different reinvestment rate assumptions. The internal rate of return assumes that the cash flows, interim cash flows from the project, can be reinvested at the IRR. The net present value assumes those cash flows can be reinvested at the cost of capital. Again, net present value is the preferred measurement to use because that's considered more conservative. It's not clear that given one project with a fairly high internal rate of return, you can find other projects to invest those cash flows in with a similarly high internal rate of return. Assuming the reinvestment rate is the cost of capital, all we have to assume there is that cash flows from the project could be used to go into the marketplace and buy back our stock and buy back our bonds. We could at least avoid our cost of capital by doing that. So earning that on the cash flows is the more conservative assumption. Now, we've had a couple of reasons to prefer NPV over IRR. The thing about IRR that's attractive, or one of the things, is it gives us a measure of return. So, for example, we looked at that project that had a required rate of return or cost of capital of 9%, and we decided that it had a positive net present value. But that doesn't really tell us about our margin for error. When we calculated the internal rate of return for that project, we saw that it was 19.3%, I think. Quite a bit higher than our cost of capital. So that gave us a little idea of kind of the margin for safety on that project. Now, we think it's going to have an internal rate of return of 19%, but even if we were 5% too high, it's still a project that would increase the value of the firm. But there are additional problems with IRRs. One is you can have more than one IRR. If there's more than one sign change, remember we talked about a simple project where the initial cash outlay is negative and all the other cash flows are positive. Well, that will have a single IRR if it has one. But if we have more than one sign change, so 3 years into the project we have to invest some more money. then we can have two internal rate of returns. This is just a mathematical thing. There can be two solutions to that equation that says make the present value of all these cash flows equal to 0. So when we have multiple IRRs, we don't know which one to use. One isn't better than the other in any mathematical sense. They just both solve that equation and make the net present value 0. And there could be projects where there's no internal rate of return that will make the net present value equal 0. And yet we may have a positive net present value. So again, the net present value method doesn't have these problems. It's a measure of wealth. It's theoretically very strongly supported and gives an indication of how much more the firm will be worth if a project is undertaken. So, with all these methods, and we arguing strongly that the net present value is the way to go, what's the relative popularity of these around the world and across companies? Well, by location, European companies are more likely to use the payback period. And you might think, well, the bond markets aren't quite as developed in Europe as they are in the U.S. There's a lot of bank financing that goes on with companies there for their debt financing. So they might be more concerned with liquidity, with getting their money back. So whatever the reason is, you need to remember that European companies are more likely to use the payback period. By size of company, the larger the company, the more they are likely to use net present value. Well, you could think of that in terms of complexity, I guess. The net present value is a little more complex measurement, and larger companies have more resources, bigger staffs, things like this. In terms of public versus private companies are more likely to use the payback period. And again, you could look at their access to debt capital here and say, well, with less access to debt capital, they might be more concerned with liquidity. And by management education, the more educated managers are more likely to use net present value. That's probably because we teach it so strongly in business schools and in the CFA program. So more educated, more likely to use NPV. Private, more likely to use a payback period. Larger companies more likely to use net present value, and European companies more likely to use a payback period. Now, one thing I want to add, why would you have to just settle on one of these? Well, you don't. You can look at the payback period as well as looking at the net present value. If you have liquidity concerns, address them with the payback period. And then amongst those projects that satisfy the liquidity needs your firm has, then select the projects that have the higher net present value, or that bundle of projects that has the highest net present value if you have limited capital. And our last slide here, the relationship between net present value and stock price. Well, we haven't exactly tried to keep this concept a secret. The net present value is a direct measure of the expected change in shareholder wealth from a project. And we're saying here you can estimate the increase in share value as this net present value divided by the number of shares. Now that said, I'd like to add one caveat here, and that is the ability to find positive net present value projects and grow earnings is often already priced into the shares. If you take a fast-growing company like a Google or an Apple or a Cisco, well, we fully expect all of these companies to come up with some positive net present value projects in the future. So to the extent that that expectation is already in stock price, don't expect the stock price to jump by this amount we've described here just because Apple announces that it has a new product. Now, if it isn't expected, and if it's really large or really unexpected, then we could certainly see some movement in the stock price. Just a caution that in the real world, a company finding some positive growth opportunities and positive net present value projects is often already baked into the stock price. But theoretically, an unexpected new project with a positive NPV should increase the value of each share by that NPV divided by the number of shares.